Hello and good evening. This is Doc Severson for the TheoTrade report for Tuesday, March 21st. Well, spring is finally here, and with it, finally, some volatility. Now, I felt like I was, going through Groundhog Day over the last few weeks saying, yep, we should be trading in a bigger range here really soon, any day now. And this is what has to happen. This is why I always say that tops are a process while bottoms are an event, is the top has to build itself. And what we had to do was to print that lower high setting up. Okay, so all the way along here, we have higher highs and higher lows. Here's a higher low, lower high, lower low. Okay, the lower high always is so dangerous because nobody sees it coming. So here we are for the first time in 109 days that we finally had a 1% day to the downside. Terrific. Okay, so let's peel back this day and see what actually happened and what we can learn from it and what we should really be expecting going forward here. So first of all, we'll just look at this 29 points on the S&P. Not bad. Certainly not crash variety. This is nowhere near some of the days that we've seen in the past that have generated similar types of movement like this. I do recall about 10 years ago, we had this day that came along literally out of nowhere, and you could just barely see it over here. It was back in February of 2007. It came right at the end of the month, and it was in a market that was just extraordinarily bullish and very complacent, very similar to what we've been going through here, and all of a sudden it comes out of nowhere with a 60 handle day. Well, we didn't get that. We had about half of that. But it's a start. I'll take anything at this point. So first of all, again, 29 handle day, that's not going to stop the world, especially coming from 2,400 up here. So right off the bat, it doesn't strike me as being all that significant. Perhaps it's just the shot over the bow that kicks off what should be a longer-term consolidation pattern, which is what I've been talking about for the last few weeks, perhaps a range between 2,300 and 2,400. This is going to allow the S&P and many other markets to kind of hit that reset button and consolidate this massive epic move. Really, if you think about it, this move has come off of the bottom from a year ago, from February of 2016, and has now moved about 600 points off of the bottom and is just about, well, let's say beyond exhausted at this point, and has matched all these historic lows in terms of the linearity of this move and just the strength of it in the course of a year. Okay, so let's go across different markets and see how this fared as well too here. So here's the Dow Jones again with a lower high setting up and dropped about 237 points again, just a little bit over 1%, very similar to the S&P. Looking at the Nasdaq composite, let's look at that one first. Not bad, almost a 2% move here, so 1.83%. So this was a very strong move. This was an extreme. This did not come from a lower high. This came from a higher high. And this is why we have so many more people trapped up at the top here, because they never got a chance to get out. So from a higher high, we've gone to a lower low, perhaps a little bit more of a movement here and a reaction from the Nasdaq composite. Okay, if we look at the Russell 2000, also the Russell 2000 is setting up with an important lower high, lower low combination. This has actually now started to trend to the downside on the daily chart. So this is a daily chart downtrend after a small uptrend here from a large consolidation. So this is more significant actually than the others. Okay, so let's look a little further in the market internals here. Here's the S&P 500 spiders, the ETF on here. And what's nice about this is we can look at volume, and really we can see that for this volume here, this is actually lower than the volume that we had during the big gap up after the State of the Union address. And it's just a little bit more than the typical Fed day that we saw, right? And then here's options expiration last Friday. So this really, from a volume perspective, is not that impressive. What we like to see from a volume perspective on days where we truly have distribution and a change in character like this is easily double. Normally we see about double the volume on stocks that are really, really selling off. We can see how this compares if I go out to the full chart here. This is the Brexit move where we had volume that was much, much higher than we had today. Here is the election move. Again, volume much, much higher, about double what it was today. So today is really just a very kind of a ho-hum reaction so far. Now, part of the problem, if I zoom in here to the sector spider ETFs to begin with, is that I can see that we didn't have everything correlated. We didn't have every sector getting hammered. And this is really what it takes to get a market truly selling off, is you got to have everything just bleeding red across the board. In this case, we didn't. We had XLU, the utilities, were viewed as kind of a safe harbor. So a lot of assets shifted into the XLU and avoided that complete sweep across the board and probably kept a lot of points on the board that could have been sold off. Here's the other concern that I have. The VIX is just, obviously a big day in relative terms, but still within the Bollinger Bands. It's still not one of these big days that we have, right? So if we zoom back out here, we can see just how complacent things still are. This is starting to paint the picture now that we have this nice big 29 handle day to the downside, but nobody really believes in it. Nobody really believes that this is anything more than just a way to distribute assets. This is not the beginning of something huge. At least this is the way that this overall market condition is starting to look at. If we look here at the RVX, which is the volatility index of the Russell, perhaps things are a little bit more serious over here, but again, still right back in the range and still not displaying any kind of fear right now. So there's no fear. 29 handles of movement to the downside on the S&P, over 1%. Okay, it is significant, but to me, it's just the beginning of perhaps something where we do start to build that larger range, which is really what I've been saying over the last few weeks, right? It's the same thing. I'm just expecting to see a range built up here. So just that range building up to be something more on the order of this. And actually, if you look at the expected move as of yesterday's close, the expected move for the April expiration, so about 4.5 weeks from now, was down to about the 230 level on the spiders, or 2300 on the full S&Ps. So this once again sort of says this is what we should be expecting. And if you look at this on the monthly chart, this is really no big deal. This is nothing different than any other range that we've set up over the years. So it's been long in coming, long overdue for this range. But I think once we set up this range, we'll be able to trade within this range and we'll have opportunities for this. Now, if something like this occurs, again, I'm just sort of saying that this is just a range in the midst of a strong bull run here. If this starts to move more than that, so if we start to really move significantly below 2300, perhaps all the way down to 2200, then I'm going to take that more seriously. That's going to be more serious because that improves the odds that any bounce up is probably going to be a lower high on the weekly chart, and that could be significant. That could be that change in character that shows that we're moving back into sideways and volatile character again. Right now, I don't think that that's happening. I think that we're going to just work within this range. We're still going to stay within quiet and trending character, which is similar to what we've seen here, and then, of course, here since last year's Brexit move. All right, folks, that is it for today's report. Thanks for listening, and we'll see you tomorrow.